You mentioned investing in Memphis, but I think you also mentioned before that you're also investing in Canada. But where are you investing right now? And maybe talk about some of the differences investing in Canada and the U.S.
Okay, sure. So we when we started, Michael, because we're based in Saskatchewan, the majority of our properties were in Saskatchewan. Also, because of what was happening in our own backyard at the time, our own personal house, just to give you an idea, we started investing in real estate in 2007. From 2002 to 2007, our personal house doubled in value. And so we could see the stuff that was happening, and the rental market had not caught up to that yet. We bought that first 24 unit at 75,000 a door. Now those same units, we ended up condo converting them and selling some of them out at 145. Again, just what was going on in the market at the time. Now those apartment buildings are selling around 100. We wish we would have just kept them. So the market dictated, because at that time, like 2008, 2009, we were actually going to the States a lot looking to invest, but we couldn't get financing. And we needed to be able to get financing to make it work. And in Saskatchewan, we were easily able to get financing, CMHC financing, which is kind of like your Freddie Mac, Fannie Mae type financing. And so we were easily able to get financing here. So we only had to put 15, 20% down. And in the US, we were encouraged to be buying everything with cash. At the beginning, we didn't have that option. So we bought mostly around here in central Canada, Alberta, Saskatchewan, Manitoba were our biggest purchases. And then now with moving into the US, we're finding deals like the ones in Memphis. We ended up paying cash, as I mentioned, 21,600 a door. Lots of upside potential. Again, you have to pay cash because you can't get financing for stuff like that.
So that's, I'm sorry, that's a function of that property, right? Or was it a function of you investing as an outsider? Or was that because the property was so distressed? Or why couldn't you get financing for this deal?
Distressed. Yeah. Yeah, it was so distressed. It was highly vacant and very run down. The people that had owned it had hired local management and then just kind of left it for them to run. And they did not do a very good job. And by the time I think they realized, they really had no choice. The lender was going to take it away from them if they didn't sell it.
Huh. So Edna, aside from the financing piece, so you kind of have two playgrounds. You have the Canadian playground and the American playground. What are some other like major differences between the two markets right now that point you in one direction or another? Just because I don't know much about the Canadian markets as opposed to the US, but it's always interested me.
Pricing is the biggest thing. Right now we have a really hot market in Toronto and Vancouver because they're like the places that everybody wants to live, and the housing market just keeps going up like exponentially. Houses people paid 300,000 for 5 years ago are selling for 600,000 now. So people are seeing that play in their own personal home, and they're wanting to take advantage of it. So they're starting to look at, buying a rental property, maybe another house or duplex or triplex or multifamily. But in those larger centers, the price is absolutely outrageous. So just to give you an idea, in Toronto, just recently, I was approached by a lady telling me that she would love to be able to refinance her building. So she was told that it's valued at $2.5 million. But the most she could get for financing on it was 1.2, of which I think 600,000 was already financed. And she was wondering if I could help her. Fact is, the numbers did not dictate any higher of a mortgage than that. So even though they're told your building's worth 2.5, they can't get financing.
So that's so interesting. So it sounds like it's a pricing component, and then obviously financing is a huge part of it. So the big question is, how do investors from Canada invest in the US? Like how do they logistically figure that out, and how have you figured out that kind of setup?
Well, you have to have a power team on the ground wherever you buy. Like I have students from Toronto buying in Saskatchewan. Well, you have to set up a power team in that area. Power team is like your realtor, your mortgage brokers, your lenders, your renovators, your property managers, all that constitute as your power team. And so you have to build that wherever you're going to be buying. And what we generally do is we find the deal, and then we build a power team around that deal. Now, we might start with the realtor we bought the deal from, or the private person we bought the deal from. And then who do you use for property manager? Who have you used for renovator? Are you happy? Are you unhappy? Interview them ourselves, and then just kind of expand it like that.
Yeah. So with the power team, that's the operational side. But what about like actually getting them into the US? So like, because they're from Canada, obviously. So financing is harder. Do they have to invest into a US LLC? Like, how does that side work exactly? How is it legally done?
With us, because we were dealing mostly with Canadian money, we had set up a Canadian corporation that bought the properties in the US in an LLC. So the Canadian corporation owns the LLC. Does that make sense?
Yeah. Okay. So Canadian LLC owns corporation, buys into a US LLC. Yeah. And then there's probably a bunch of legal work. Are there company agreements or any of the operating agreements? Is any of that different as well? Or is it just, it's kind of
pretty close to the same, because you just got to detail like what's expected, how everything's going to play out, how it's taxed and all stuff like that. And because the way it's set up, our Canadians are taxed in Canadian dollars.
Recently, we had an American couple on that were actually living in the UK, and they were doing the same thing. I also hear a lot of people saying, "Oh my gosh, how do I invest out of area?" Right? And then listening to you, well, that's the way you're doing business. You're investing out of area. What are some of the things that you do? You talked about setting up your power team. Is there anything else that you do to kind of set yourself up for success when you're investing out of area?
Well, you got to know what's going on in that particular community too. Like we really concentrate on workforce housing. So we have a demographic that we're catering to, and it's workforce people. So we don't buy things like with pools and, all these exotic community areas. It's workforce housing, basic housing. There's no granite countertops, in some cases, there's shared laundry. We might put laundry facilities into the unit if it makes sense, but it's basic housing.
So, okay. So workforce housing. So you kind of, let's say that, again, you got the Canadian playground and then you got the US playground. So you have to pick specific markets inside the US. What, like, aside from your power team, what makes you decide to go into a specific market in the US using the whole US as a playground from Canada? So you have any metrics you look at that you like? Or?
Yeah, it's got to be a growing community. Like we're finding that there's lots of really large companies setting up more and more in Memphis, like FedEx and Nike and different stuff like that. So we really get to know what's happening in the area. Is it a growing community? Or if it's flat or stagnant, then there's not as much opportunity. So yeah, really growing community. And that's pretty easy to find out. There's lots of, reports out there will tell you what's going on in different communities. We kind of had an interesting start in Memphis. How we ended up in the area is one of our partners was working for a Canadian REIT, buying properties throughout US for them. And with a REIT, there's rules. So with a real estate investment trust, you can only buy so many properties in each area. There's like a diversification thing. And they had got to their limit. They couldn't buy any more in that community. And our partner approached us and he said, I'm still finding a lot of really amazing deals here. And he couldn't raise capital himself. He was the deal finder sort of thing. So he brought us in as partners to fund the deal. And that's how it started. So he was actually working under another umbrella. And of course, they got a big background or team members that are vetting the areas. So that's actually how we ended up in that area.
So we shied away from this a little bit earlier, but I am curious. How does a Canadian get financing in the US? Is it just partnering with someone that is a local? Talk to us a little bit about how you've been able to successfully do that.
You know what? We're just working through the process, so we haven't successfully done
Okay.
it because
Oh, so you haven't. Okay.
our first large purchase in the U.S. was last March, so March of 2020, and then our second purchase was March of 2021. So we're still optimizing those buildings. But what we're doing in the meantime is we're talking to different lenders. We're reaching out to them to see what's feasible. But our understanding is, and of course, we 100% know till it's a done deal, is that once the building qualifies, and then from there it's how you set up your corporations with the help of your lawyers and stuff like that on how it needs to work as Canadian owners.
So you would do a deal that's cash in the US over a deal that's half financed in Canada right now, even if you got 50% financing in Canada. You've done the last couple of deals you said in cash in the US?
In the US we have, yeah. Yeah.
So why is that more attractive than doing a 50% finance deal in Canada?
We can't buy a parking lot in Canada for $20,000. Cannot. Like I'm telling you, Toronto and Vancouver, like you can't buy a parking lot for $20,000. And if you can't put 20,000 into a parking lot to make it worth more, we can down there. And so it's a case by case basis. I have students buying across Canada right now at really decent prices, but nowhere near that. Like we're talking decent prices, $65,000, $75,000 a door, not 150 or 180 or 200 that some of the places are asking for right now.
Yeah, it might look like from the outside in that you're unprepared, Edna, for this deal, because we asked you a question about the financing and you're not exactly sure, but I love that because again, a lot of people try to have everything lined up. They want to know every little step all the way to the end. Yeah. Now, why are you doing a deal when you don't have all the answers? Like, why would you ever proceed with that?
Well, because there's always more than one exit strategy. And I have partners that work on that kind of stuff. Like they're the ones down there. They're working on the ground. They're talking to the different lenders. So we have no problem. We have no problem that it's not going to happen. It's just exactly how it's going to happen that's going to make a difference. And you know what, Michael, worst case scenario, if we don't get funding, we sell it out at our new price. Still good. Yeah.
It's a really good point, actually. So how do you pitch this to your investors if there's so many different exits and you obviously want to plan for the downside risk as much as possible? So like when you're pitching this to investors as an all cash deal or whatever, what does that look like?
Well, we have to give them all the nuances that could happen. And of course, you can't project everything in real estate. Anybody who's been in it for any length of time understands that. We deal also only with accredited investors. So their timeframes are different, their risk tolerance is different, that sort of thing. So we just basically tell them, would you like to buy a parking lot in Toronto for $21,000, or would you like to buy an apartment building per door with $21,000? So cool. It's like, which one would you buy?
So you compare it to the actual unattractive prices in Canada, and you say, "Listen, we're doing this thing over here. Why not find the Memphis of Canada, though? Does it not exist?
Not at those prices, and not with any hope for huge increases like that. And I'll give you an example. We bought 144 units in northern Saskatchewan back in 2012. We're doing excellent with that deal. We paid around $40,000 a door, which, by the way, is the lowest we've ever bought anything for in Canada. And it was owned by a charity. So it actually took us a while to make it happen. It took us 10 months to pull it all together. But in 36 months, and we knew just from cash flow alone, if we didn't do anything different than what was already being done with the financing we got in place, CMHC financing, 15% down, 85% financing, we knew we could have our investors paid out in 4.5 years just from cash flow. But our intention was increase the rents, renovate the units, and make it worth more. So in 36 months, we had done that. And it took us a while because the building was full when we bought it. So it was fully financeable and full. We paid out all our investors, took a nice payday, tax-free, because it was a loan that the building is still paying for. And we still own it to this day. But there's no 3, 4, 5% inflationary increases. It was all forced appreciation. So you have to take that with a grain of salt too. Also, population 3,000 people. A lot of people won't even look at that. So it was a whole bunch of people from Saskatchewan, a bunch of us from the north who understood it's the gateway to the north. Prices are probably not going to increase exponentially up there. We were buying it for long-term cash flow.
You know what I love, Edna, is that you are overcoming a lot of challenges that will stop most people in their track. They're like, see, it's too complicated, can't be done. And I love that. Can you just boil down a few lessons for people watching, listening to this right now, that people want to do what you've done, and maybe there's an obstacle here and there? Like, what are some of the key takeaways that you want to leave people with?
Well, whenever you're moving forward, you have to make a decision, and then you make that decision work for you. You don't second guess everything that you're going to do, because you could drive yourself absolutely crazy. You know, going in that there's certain challenges you're going to face. Like, we're not going to get 3, 4, 5% inflationary increases in there. If we don't force the appreciation on the building, cash flow is not going to be there. And we also don't put all our eggs in one basket. Like, we're in several different communities. We understand the demographics and the industries of those communities, but we're also not scared of smaller communities at all. And a lot of people are.